Okay, so this isn't a video I really wanted to make, but it's one of the ones that we kind of have to make. Everybody's so engrossed in fear right now that what we're going to have to cover today is just a little bit of boring education on the bank failures that have taken place, how interest rates are created, and dispel some myths. So stay tuned. Okay, so welcome back. Fact number one, interest rates are not set by the Fed. You say, well, Jason, but they literally said that they've raised interest rates, and that's true. What they've raised is the rate that they lend money to the banks, right? So believe it or not, your banks don't have a whole lot of money, so they borrow money and they lend that money and they charge based on the spread. And this requires us to have a conversation a little bit about how banks work. So you come in and bring in money into a lending institution, and what they do is they're required to keep a percentage of that money available. So if somebody were to come in and say, give me all my money back, that they have the revenue to be able to actually give the money. However, if people came in representing 30% of the total deposits and asked for all of their money, the bank wouldn't be able to in a single day to fund 30% of their total deposits going out in actual cash. They don't have that capability. So how do they lend on these mortgage bases? Well, it's what they call the secondary market. And so when the Fed raises interest rates, the rates at which banks borrow money, the bank charges you what's known as a spread. They charge more money, the difference between it. This is how some people got a 15-year mortgage at 1.85% at one point because the Fed interest rate, what they were charging banks, was zero. That's how you can do that. So right now, with them raising those rates, they have one function. So this is what we got to talk about for a second. Why would the Feds raise interest rates? The Fed said they were going to raise it another half a point. They've been steadily raising the rate, right? It's been going up and up and up. We hit into the 7% as far as a 30-year fixed first-time home buyer regular mortgage was looking. So the Fed said they were going to go up another 0.5% after they just did an increase prior to that. And so the market is starting to go, this is getting expensive. They said they were going to raise it 0.5%. And instead, when they came out, this is the first time in this recent price hike that they've been doing that they only raised it 0.25%, which was an indication to the market that they were backing off their policies because they understood that their increase of interest rates had caused problems, right? So what happened is they went up 0.25 point instead of 0.5, and the market got better. Interest rates got better. If they decide to roll that back 0.25%, interest rates will get a lot better. So this is one of the things that you need to understand in this. Even though banks have to borrow from the Federal Reserve and that interest rate does affect mortgage rates, it's not like it has no effect on it, but it is not a direct correlation. There is some swing in what that looks like based on investors and how the bond market and mortgage-backed securities work. Now, you can geek out and go totally down the rabbit hole on this, but it's not necessary. What's necessary to talk about is what caused the Fed to calm down. Well, there were 4 major banks that basically failed due to these massive price hikes. Now, as they increase the interest rate, their job is to quell inflation, and the only way they can do that is by slowing the flow of money by making money more expensive. That makes sense. Well, they delayed for so long due to what happened in 2020 and 2021 that inflation got out of control, and it's like driving a car at 100 miles an hour, and rather than slowing down over time, you hit the brakes so hard that you actually lose control. That's what they did, is they basically tried to slow the economy so fast that what ended up happening is confidence changed from an economic standpoint, and prices started to, well, not prices, banks, people did a run on banks, and they didn't have the assets to do it. They fail, and the FDIC has to step in. This is some of the craziness that is causing this. So understand that technically a recession is defined as, I believe, 2, if not 3, consecutive quarters of negative GDP. And so, by that definition, we're technically in a recession, but supply and demand is still king. When it comes to the real estate world, we are actually in a supply deficit. In fact, we actually may be in a supply crisis. In our next video, we're going to actually take a look at some of that data. We're going to talk about how new households forming and the lack of new construction to meet the demand of new households may permanently put us, or at least for a very long time, into a supply deficit. If we don't have enough supply to meet the demand, prices will continue to rise. We'll connect with you again next time. Thanks so much for tuning in. If you're looking to buy, sell, or invest in real estate, give us a call. Thanks so much.